We are going to we are going to look at training reversals, and we are also going to look at internal structure. So I'll be showing you using a live chart, then I will show you using an example. So this is a chart for USD card, and you can see from here after the market reacted from my POI here. I'll not go into detail on this POI. The market started trending up. Now, when this market is trending up, it's also creating what we are call break of structures to the upside. So if I'm following this market, I'm following this break of structures to the upside. The most obvious break of structure to the upside is this one here, because it took out this inducement. It took out this low here. So if I really want to put this low, right, this is where the low should be as per our valid pullback theory. That's where the low should be. And we have the market. The market continues to go up. So now, at what point do we actually get our reversal? From here, right? You can see that if you look up here, you see that this is our last break of structure here. Now, why did I say this is a last break of structure? If you look here, this is our pullback. The market comes below, takes out this pullback, and goes ahead to break structure. So that's why we have a break of structure, and we have an inducement taken out. So if I zoom in, you can see that. If I zoom in, you can see that. So that is how we have been taught to mark structure, right? How I've taught you guys to mark structure. And if you look at this here, you see that okay, after marking this structure, if you want to buy here, we still need an inducement. But what will happen here is this was our inducement leg here. This was our inducement. This inducement got taken out, and our low got violated, right? When this inducement was created, this became our strong low here. So this is where our change of character is. So looking at this, I know that when you just look at that with your clear eye, you would not have been able to spot all this. But you look at this, right? The market goes up, creates a low, then comes back and sweeps that low, then finally closes above structure, giving us a valid break of structure. Then it pushes down and gives us another pullback here, which acts as our inducement. Now, if I'm to outline this in our chart, we'll have something like this, right? If I'm to use a diagram, this is what we are going to have. So, as I was saying, so if I'm to highlight this, right, we see that this is our first pullback in this case. That is a pullback which I marked as my inducement. Once this first pullback is taken out and the market closes above and gives us a close with a candle body, right, we have what we call a break of structure. That is the criteria. Now, for you to enter a trade after this break of structure, you still need an inducement. You need an inducement before your point of interest. So you need to mark out your first low, the first pullback, which is this one here. Once this first pullback is taken out, right, we have our inducement taken out here. So we can look to buy here. In this case, there was no valid POI to buy from under that low because there was no valid POI here. So the market went ahead to give us a change of characters. A change of character. So this is where our change of characters was. That is where our change of characters was. So this is basically just what happened here, right? We have our inducement. Inducement got taken out. Price close give us a break of structure. Inducement got created here, and the our strong low got taken out, giving us a change of characters. Now, when that happens, right, you are trailing this leg now. So the first thing you do on this leg is you identify where your inducement is supposed to be at. The first low, it's your inducement. Now, when you mark out this first high here, right, this first lower high here, that is your inducement. What are you looking for? You are looking for a first you are looking for your pullback, your other block here to sell from. Now there are two scenarios here. You might have a decisional and an extreme. What is a decisional? A decisional is an order block that is unmitigated above your inducement. So after this inducement, if there was an unmitigated order block here, we could have used it. That one is a decision that it has a 50-50 probability of working or failing. So after that, the market came and tapped into this. So once it taps into that, you don't need to hurry. You identify your change of characters. This is our first low here, right? The market pushed down, created this low. So this was our last low here. So after the market tapped into our point of interest, it came and took out that low, giving us a change of character. So we could look to sell here, or either wait for this to close below here, right? To close below here, give us an inducement and we can sell. So this is how you see me getting the trades I've been selling in the community. So after that, right, you can also trail. This is an internal break of structure here. If you look from here, you see that we have this internal break of structure. This is an internal break of structure. Why? The market took out this inducement here, right? This was our level of inducement. The market went up, took out that inducement and break below this low, giving us our internal break of structure. So from this our internal break of structure, we just need to mark out our inducement. After marking out our inducement, we wait for price to return to our point of interest, right? So in this case, this was our extreme point of interest. If I go ahead with price and you look at it, you see that when price came back to this other block, we had this massive drop here. That was the massive drop. Obviously, there were many pairs to this. So now, what I want to show you, the next thing I want to show you guys is internal structure. Many people just believe that if the market is pushing up like this, right, the market leaves you an inducement. After the market comes and takes out this inducement, you buy. Now, many people many people will agree with me that after the market takes out this POI, after the market takes out your first low, right, which is your inducement, you can buy as per what I've been teaching you guys. But what many people don't know is if you miss this entry here, where can you possibly get in? Because if you are buying from here, probably you are targeting this zone. Please let me add in this person that wants to join. Okay. So as I was saying, if you are buying from here under your after your inducement, right, you're probably targeting this zone. So when I give a trade, like if I give a trade and somebody discover that the trade has already left this zone, the trade has already left this zone. Now the person starts to panic because the person thinks, oh, if I'm buying up here, this is how my risk to reward ratio should look like. Now, now this is how my risk to reward ratio should look like. You are risk to reward. Now, if you look at this case, now this is a risk to reward of 1:2.36. But if you see that maybe from the original POI, original POI, it was around 1.11. So when I give this, you start confusing and you don't know where to enter. You should understand that both this leg, right, this leg will not just shoot off massively. The way the leg moves, it moves like this. It also has internal break of structure, takes out inducement, break structure, takes out inducement, break structure. So initially, if I give you this and on a bigger time frame, you see that maybe price is somewhere around here and this is just a sweep move. Now all you need to do is scale down to that entry time frame. You look for this, here, right? And you try to identify this structure that is forming here. If you identify that, okay, this is my inducement. Please, there was somebody that wanted to join in. So if you identify that, okay, this is my inducement here, this is my valid internal break of structure, then you can know that, okay, I can now look for a different point of interest here, and wait for price to When price approaches that point of interest, I can now look for my position and buy, right? I can now look for my position and buy here. Sorry about that, that's the wrong tool. And buy here. When I buy, I don't not necessarily need to keep my stop loss here. I can just put my stop loss now below here. You can see that, okay, at this point in time, I'm going to have around 1:12, maybe even original bigger than the original risk to reward of that entry. So this is how you get multiple entries. You see the people that do flipping, it's not through magic. It's not through magic. It's just that you guys are not. I don't really encourage that. This is how they get their entries. Once somebody has his bigger time frame point of interest here, once the person has his bigger time frame point of interest, price comes and taps into that point of interest, gives the person the confirmation that the person needs. And once the person has entered into that trade, once the person has entered into that trade, right, the only way that you can scale in is you wait for this internal structure to form out here. You identify your internal break of structure, and after your internal structure, you identify your inducement and you identify your point of interest. So so if you see somebody that you want to scale in a position, right, the person doesn't just enter anywhere. The person just doesn't just enter anywhere. If you enter anywhere and you are reaching the full your full account size, you're likely to get stopped out. Your other account will run out of margin. So if the person enter one position here, the stop loss, please, these guys should slow down. I asked them to join earlier. They did not join. It's just now that everybody's flooding in. So if you see now somebody enter his initial position at the bigger time frame POI, right? Majority of the people they don't enter that much here. They wait for this internal structure to start forming. They start trailing this internal structure. Once the market gets to an internal structure, right, into a point of interest in our internal structure that aligns with our directive and meets the criteria, then a person can add in one more position here. And we always know that the market doesn't just move in a straight line. That's why majority of you have tried to flip and you failed. It's because you just want to jump in at any point, any small retracement you see, you want to jump in. That small retracement can also be an inducement. It can also be an inducement, and you end up moving. You will end up being above your margin requirements, and you get up, end up getting close. Once you enter one position here, once the market start moving up, you are trading this position here. You are trailing this. Also, in this zone here, right, a change of characters may occur. A change of characters may occur inside all this movement here. So if that change of character occurs, you can know that, oh, this trade like this is becoming dangerous for me to still remain in this trade. So it's probably time I move my stop loss to break even. So we need to put importance into this all this internal structure. Once the market taps into your point of interest, if you want to add a position, you need to understand this internal structure here. After this here, right, after a break of structure, you can still wait for this thing, you buy here. After that, that's how you see people adding positions. When they buy here, they put their stop loss below here. That's how you see somebody stacking 100 positions. It's not because there's some magic behind it. Once you buy here, right? If you buy here, price pushes up a little. Your margin requirement, your margin has added, your free margin has added, right? Your free margin has added. You can have a liberty of opening another position and calculating and putting the stop loss here, just like that. And when the market finally attains your TP, you can see that you have multiple layers. But I'm not encouraging people to do layering. It's dangerous and it will require you time. So I think majority of what I wanted to show you guys is there. I demonstrated that here, right? I demonstrated that here to you guys. We have another block here. This is our initial point of interest. The market taps there, goes down. This is our internal structure break here. Right. After this internal structure break, let's say I entered one position here. I entered another position after the market took out this inducement here. Enter another position here. And when the market push again and did not meet all my TP, I waited and entered another position here, and the market finally hit my TP. Instead of me getting maybe my one is to this was a 1:4 here, I should have gotten at least this will be around a 1:5, another 1:4 here, and 1:6 here. So those will be what I consider layering in this case. That is how you trade if you want to go full margin. That's how you go full margin. Don't go full margin. Come for a full margin trade. You take all your entries, you pack them here. Small movement, the price move removes you from the trade. That's what I've seen majority of these guys doing. If somebody comes say, "Oh, I have $10 in my account, I want to enter this position," somebody will just carry that $10, open like lot size 10 here. The person doesn't even mind to calculate how much is this lot size. If you have $10 in your account and you want to risk it there, you need to calculate how much this zone like this, how much if I'm putting my stop loss here above here, how much will this stop loss be if it hits? This stop loss needs to be exactly $10. Don't carry all your money and come and put it here that only small movement like this price will blow you before moving in your favor. That is not good. That is not good. That's not a good way to trade. That's how you calculate your risk. Calculate where your stop loss is supposed to be and calculate your account size. If your account size is $10, all $10 all you have, make sure that where the market is supposed to blow you is where your account, where your stop loss is supposed to be. Don't make you think that the market will just shake and blow you, then it starts going in your favor. You start crying. It happens a lot. You see here, these are setups I've been sharing in the group. These are setups that I've been sharing in the Telegram, and I think majority of you guys are there. This was a setup. I also shared this in the free channel. That's it, right? Break of structure. Let me show you. There's nothing complicated in this. We have break of structure here after inducement is taken out, right? We have break of structure. We have a point of interest. Then we have liquidity, and the market taps into our point of interest, and we are good to go, right? Liquidity can replace inducement. So if you look from here, this is what we call a minor inducement. This is what we call a minor inducement. So let me explain this to you. We have this move. We have this major move here like this, right? So this measure move will complete when price closes below this low. This pullback will complete when price closes below this low. But now, in between, before it reaches that low, it has some few other small pullbacks. So all these pullbacks that occurred in between this big pullback is what they call a minor inducement, or yeah, it's a minor inducement. So the bigger pullback is what we refer to as our major inducement in this case. So that is how we trade. If you have any questions, you can ask, right? Oh, this is a trade. This is a trade I've been looking at. This is a trade I was looking at. Oh, I forgot about this setup. I forgot about this setup. This week has really been slow. So I think if you have questions, you can ask. I never had a lot to teach you guys. I don't know. If you have questions, you can ask. Somebody is asking, please, can you teach derive? Can boss, please, can you teach derive how to carry spikes? Um, the thing is, the strategy for derive I came up with myself, and I've not yet defined rules to actually teach it. So for me to actually teach it, I need to really sit down and write out all. So if you look at this, if you look at this, right, what I require for this pair is for this move to try and break below here. Once this move breaks below here, what I will require now is something of an inducement like this. And once it takes out, I can sell. I can sell. So this is a trade that we just stumble on a live market, right? So I'll have my extra point of interest here. You know that this is a type of trade that Mr. Abisonawa will like. Madam, these are the type of trades that you like. Very precise. So we also happen to have a minor sweep of this high. So if this market happens to close below here and then gives us a retracement, then I'm willing to sell this pair. I'm willing to sell this pair. So actually, if I sell this pair, what am I expecting? I'm expecting to take partials when the market gets here. And that's one thing. That's one thing people don't seem to understand, where to take partials. Now, why am I taking partials here? You see this other block here. This other block might still cause a reversal to the upside. Then if the market passes that, right, all of these other blocks here are mitigated. So if I go back to my bigger time frame, the nearest place which I'll be required to think about is this zone as well. So if price passes all of these zones, then it's heading to this area here. So that's it. We have this zone and we have that zone. For the derive how to carry spike, it will take a long time before I can come up with that strategy. I've not really seen a way that I can really document that strategy yet. And personally, I don't take it that serious. I trade just when I'm bored. So if you have any questions concerning our past lessons, or you have anything that worries you on the chat, something that you do not understand, you can ask. You turn on your mic and you ask, and let's work on it. I think a majority of you have learned how to properly scale in major positions, right? If you want to scale in positions, where to scale in, and why you are scaling it at those zones. You might have the heart to flip, but you don't know where to enter your next position. That's where the problem will come in. If you don't know where to enter your next position, you get fright in the market a lot. So here now we have two scenarios here, right? We have two scenarios. You can either take an impulsive entry and hope that the market holds at this zone, right? Just hopes that it holds and sell off, or you can wait for the confirmation entry which I showed you. Then if this zone fails, we look for this zone here. Then we had a similar trade on GBP card. I was live with the other student the other day when I came across this trade. So this is a trade. The market reacted from here, so then it gave us it then hit our stop loss later on. But it's so this was almost 90 pips, I think. And we took partials. We took a lot of partials. So any questions? Any questions? Any questions? Any questions? Any questions? Well, I think if there are no questions, we'll end here for today. Lopez, what is it? I saw what you did. Lopez, what is it? Okay. So that will be all for today, right? No questions for today. I think majority of you have learned one or two things. So see you in the next session.